Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing from Xerox. Usually these reports are about something pretty routine, but this one, let's just say, involves a big acquisition and a whole lot of debt, almost like they are buying a printer company to become a photocopy of themselves. This Form 8K, dated April 11, 2025, is basically a snapshot of some major moves Xerox is making. It's like a corporate, we're doing this announcement to keep investors in the loop. The heart of this report revolves around two main events: raising a ton of money through new debt and a planned acquisition of Lexmark. Xerox is taking on a lot of debt. First, they issued $400 million in what they call first lien notes. These are basically IOUs that are due in 23%. Think of it like a mortgage where Xerox is promising to pay back the money with interest and putting up some of their assets as collateral just in case. Then they also issued another $400 million in second lien notes due in 2031, but these come with an even higher interest rate of 13.5%. The higher the interest rate, the higher the risk that the lender is taking, and the higher the payment that Xerox has to make. These notes are considered second lien, meaning if Xerox runs into trouble and has to sell off assets, the first lien holders get paid first, and these guys get whatever is left over. It's like being second in line at an all-you-can-eat buffet. There might not be much left. So what is Xerox doing with all this cash? Well, they plan to use some of the money from the first set of notes to pay off some older debt that's coming due in 2025. It's like refinancing your mortgage, hoping to get better terms or free up some cash. They paid off $90 million in April and plan to pay the rest by the end of the year. They're also using some of the money to pay down a term loan. Here's the big one. Xerox wants to buy Lexmark. They're using the money from the second set of notes to help fund this deal. This is a major move, acquiring all of Lexmark's debt. Basically, they are buying the whole company. These notes are governed by legal agreements called indentures. Think of them as the fine print that spells out all the terms and conditions of the loans. There's one for the first lien notes and another for the second lien notes. It details who owes what to whom and when. The interest on both sets of notes will be paid twice a year, in April and October. So Xerox better make sure they have enough money coming in to cover those payments. Missing a payment could trigger a default, which is a very bad thing. The first lien notes are guaranteed by Xerox and some of its subsidiaries, plus they're secured by pretty much all of Xerox's assets. This means if Xerox can't pay, the note holders can go after those assets. The money from the second lien notes is being held in a special account until the Lexmark deal goes through. This account is pledged to the holders of those notes. If the Lexmark deal falls apart, then Xerox will have to pay back the second lien note holders. Xerox has until December 22, 2025 to close the Lexmark acquisition. If they don't, or if certain other things happen, they have to redeem the second lien notes, which means paying back the money plus any interest. Once the Lexmark deal closes, the money will be released from that special account. Then Xerox will basically take over the second lien notes. It's like Xerox saying, okay, we're responsible for this debt now. After the Lexmark acquisition, the second lien notes will be secured by Xerox's assets, but behind the first lien notes. The first lien notes will be first in line for the fixed assets, whatever those may be, and the second lien notes will be next in line for those assets. After the acquisition, Lexmark and some of its subsidiaries will also guarantee the notes, and the notes will be secured by Lexmark's assets. It's like everyone is pitching in to make sure these debts get paid. Xerox can redeem or pay off early some or all of the first lien notes before October 15, 2027, but they'll have to pay a premium, which is like a penalty for paying it off early. After that date, they can redeem the notes at certain prices. Xerox can also redeem up to 40% of the first lien notes with money from selling stock. It's like using your winnings to pay off a debt. If there's a change of control triggering event, which is a fancy way of saying if Xerox gets bought out or goes through some other major change, they have to offer to buy back the notes at a premium. These agreements or indentures also limit what Xerox can do. They can't take on too much more debt, pay out too much in dividends, sell off too many assets, or make deals with their affiliates without restrictions. The notes and indentures also list the events that would trigger a default, like missing payments or going bankrupt. So to sum it up, this report is about Xerox taking on a lot of debt to refinance existing debt and to buy Lexmark. Now let's step back and look at the big picture. On one hand, Xerox is trying to grow by acquiring Lexmark and trying to manage its debt by refinancing. On the other hand, they're taking on a lot of new debt, which increases their financial risk. If the Lexmark acquisition doesn't go as planned, or if Xerox's business doesn't improve, they could find themselves in a tough spot. Xerox is clearly betting that the Lexmark acquisition will pay off. They're hoping to create synergies, cut costs, and expand their market share, but acquisitions are always risky, and there's no guarantee that this one will work out. One thing to note is all the debt. These are pretty high interest rates, especially the second lien notes. This tells us that investors see some risk in lending money to Xerox. Xerox needs to start churning out some profit to cover all this interest, because otherwise the company might have a hard time. In conclusion, this report shows Xerox making some bold moves, but these moves also come with significant risks. It's a high-stakes game, and we'll have to wait and see if Xerox can pull it off. Thanks for watching. If you found this helpful, please like, comment, and subscribe for more corporate deep dives.